afternoon, everyone, and thank you for joining us for another exciting session. The important thing is, I won't give a long speech on how important it is to basically de-risk financial services, but it's also important to understand what makes it riskier, right? And simultaneously, it's also good to understand how some of the key players, such as the ones over here, are actually contributing towards de-risking financial services. And I will start right away with you, Rohit.
Yeah.
Jump on to the first question. And it's important for me to, refer to a lot of interesting insights that we have taken. So there was an interesting insight by University of California that actually found that almost 51% of the companies have lower credit default risk if they are using artificial intelligence as a part of the solution sets, right? So would like to understand how Biz to Credit has basically used and leveraged these digital technologies, and especially AI, to help mitigate these financial risks.
No, I think that's a good question. And as you guys know, AI has become the hottest topic in US and across the world. And being a US lending platform, as we are, with done over $12 billion in lending, we have been actually using variants of AI for quite some time. I will give you two very good, clear examples of that how AI actually lowers the default risk and also makes your models better. So, for last 7-8 years, we have been like any of the, so we are an SMB credit platform. So any of the businesses which come for any of the borrowing piece, they come on our platform and we ask them to connect their bank accounts, and then we get all the data, run all the ML piece. Simple things like, if they're coming in, they're inputting, giving us access to that data, and then if they disconnect that within 3 to 4 days, their probability of default goes up by 3 times. Now, manually trying to figure that out, monitoring it, keeping a track of it is impossible. But doing it through machine learning algos and then even sending them reminders, and in certain cases, it might be inadvertent. So we find like almost 30% of those people will come back, but then another 70%, the PDs are still 3x. So that's a very good example of how you can use very simple things in machine learning and AI, because I think there's a lot of hype like anything else. A new technology creates a lot of hype. But what people forget is that, when you combine new technologies with commonsensical stuff, that's the power of AI machine learning. And post-COVID, what we have seen as digitization is increasing, the underlying raw material for AI ML is all access to data. That has become easier and better. And as that becomes easier and better, it's easier to train the models. And then if you're smart as a company, you can actually put a lot of your credit models and risk models and even pricing models, based on the kind of exposure you are getting. And then you can segment your portfolios, that way. So I think that's a very clear-cut example of how you can use AI. And the other piece we have seen is also from which device they are coming. They're coming mobile, they're coming desktop, mobile, which device is an Apple device, it's an Android device. So even we see a lot of behavior difference, in that sense also. So I think that's a very important aspect to keep in mind. And that's all big data. And that has to use a lot of the AI and the machine learning and the computing power that is now available for us to not only build better models, but also to recalibrate those models.
Just to, you mentioned behavior. So
Yeah.
what have you seen in terms of the different devices and the different, I would say, behavioral things that you have seen in terms of, let's say, what specific device has been contributing more towards the, or what method has been contributing more towards the, making it more riskier?
Yeah. So like if somebody comes through mobile and wants to complete the whole application through mobile and trying to upload documents through mobile, so the average quality of that customer over time actually drops compared to somebody who's starting the application on mobile and then, taking a little bit more time and then using a desktop machine, down the line to complete the application and do it. Because sometimes they're in so much of rush to borrow money and they are, they need it. And if the need is good, it's fine. But a lot of time, if they're just in a rush to borrow money, it might also reek of desperation.
Okay. And Shailesh, coming to you, being one of the largest players in this region as GDIA. So if you look into the global market, right, it's $80 billion worth global losses that you see because of fraud in the financial services sector. you being one of the largest players and having such a large footprint, especially in Saudi, how GDIA has actually leveraged these technologies, or if you have, then what sort of technologies have you used that some of the players over here can also benefit from, and what has been the learnings for GDIA?
Sure, Namir, thanks. GDA, yes, you're right. We are one of the largest players in Saudi. We are one of the fastest and the most emerging payments player in Egypt and UAE. And we are also prone to frauds, risk, and other associated risks like any other payments player. What we've done very effectively, or we try to do very effectively, is leverage AI, leverage some of the newer technologies in forms of softwares which do transaction monitoring. But more importantly, what we do is leverage the analytical data that we have with us. See, risk is of several kinds, and I would like to qualify that. You have the operational risk, you have risk of losing customers, you have transactional risk, you have fraud risk, and we are prone to each one of them. Each one of these risks require
Especially when it's
treatment.
payments, right? So, yeah.
A different treatment. Now, purely the transactional risk is the one which is the most visible. That hurts your P&L. It also hurts your ability to expand when the hits are harsh. And we would like to monitor right from the time of onboarding a customer, where we look at where it is operating, what it is doing, what are the nature of the business, what kind of technology are they using, what kind of products are they selling, and use all of that to then compare it to peer sets as to what are their behaviors, what are their transaction sizes, how frequently are they submitting, and then use some of the technology that the schemes provide us in terms of information around previous frauds that may have happened, map it into that, and create a more holistic approach towards how do we mitigate risk. Now, one thing I would like to add is there is no company in the world which can say that I have zero risk. The risk is always going to be there. The question is all about how do you bring it to a tolerable level. And by leveraging AI, by leveraging the tools that we have, leveraging the data that we have, comparing it, and constantly monitoring it allows us to limit it or bring it down to a tolerable level. And we are doing that very effectively in some of the toughest markets like Saudi or Egypt and in UAE now.
Great, and which brings me to the point, right? So, I mean, if you look into it, Tajinder, I mean, at one side we see around $80 billion of annual losses, and then at the other side we see when those organizations that have leveraged blockchain, there has been a saving of almost $15 to $20 billion annually. As Finvacia, I mean, being again one of the largest operators in the space, how have you seen the adoption of blockchain, one, and if Finvacia has made any similar use cases that you would like to share that could be useful for the audience to also understand on how that blockchain-specific technology, because blockchain is vast, right? So how it has been leveraged to de-risk it.
I think obviously blockchain is an amazing technology, and when we add AI to blockchain, it can actually do wonders. And we've looked at a lot of different use cases. So just giving a brief background about Finvacia. Finvacia is an engineering enterprise that works in healthcare, technology, financial services, real estate. And over the years, over the last 15, 20 years, we have transacted values worth of in different brands, in hundreds of trillions of dollars. And when we look at this data and we realize, wow, this is beautifully, this is beautiful. Data is what everything AI is built on, and then blockchain creates a lot of, it helps in, expediting settlements or basically creating a transparent network of transactions, not just transactions as in financial transaction, but transaction of any sort, transaction of data, transaction of any smart contracts. I'll give you one beautiful example that within Finvacia we applied, and it becomes a very strong use case within our healthcare division. It's a little bit different from financial services. We saw that all these people around the world have so much defragmented data about their biomedical records, about healthcare, about when they go to a doctor and then they go to another doctor, the taking of the data becomes so difficult. And then on the other side, there are these pharmaceutical companies that are basically doing these clinical trials, trying to get all of this data, for doing these experiments. Why not create a blockchain where you can actually put the data of a person, of all of his medical records on the blockchain itself, and he can share it with anyone, just like sending a Bitcoin. Instead of sending a Bitcoin, you send all of this data, you apply AI on top of it, and you have something that we call magic. You're able to analyze, you're able to share, you're able to create a use case, transparency, speed, and accuracy, all of those things. If you combine these two, you're able to reduce risks, you're able to reduce frauds and checks, you're able to better comply with regulations. So it does help in a lot of those things, and we do see a lot of use cases across a lot of industry verticals.
So then this brings me to Nasser. Nasser, you have been in Luxembourg, and you have been instrumental in basically setting up I would say leading the fintech charge in Luxembourg, and along with that, actively working with the banks, and of course, you being a banker previously yourself. My question is that SVB, Credit Suisse, the recent fiasco that we have seen that has happened globally, that has led to the overall financial system being a lot more shaky, right? And it appears to be a lot more shakier now. How can these large financial institutions leverage, again, coming back to the topic of digital technologies that can help understand the risk better, lead to more stability and sustainability in the business practices?
Thank you, Namir. It's interesting hearing what the other panelists have said. Obviously, I agree with you. There are many types of risk, and it's a holistic approach to risk that is critical. There aren't any tools, as far as I can see, nor any processes that accurately or properly deal with the holistic concept of risk, right? Because the interesting element with technology, yes, we may provide a solution with technology in one area, but by definition, employing that technology, we're creating all the risks. And what you need to understand is the sum total of the value proposition and the cost benefit of everything, right? Employing an AI in today's world. Now, a lot of AI systems that are being sold to institutions are proprietary models or claim to be proprietary models. Now, therein, what you're doing, you may be providing a better form of analytics, better decision-making capabilities, better controls over, say, traditional risk, be it market risk, credit risk, liquidity risks, fraud risks, but you're, in effect, also creating technology risk, vendor risk, model risk, most critically, which is the one that a lot of regulators are grappling with related to AI today. Now, a lot of people will say, these are minimal, but let's take an extreme example. I used to run one of the largest high-frequency trading desks, so I did machine learning. Now, let's take that to an extreme level. If every trading desk in a financial institution was run by an AI, right? If you weren't effectively managing your model risk and something goes wrong, your bank's gone, right? So there are inherent risks with everything we're doing, and we need to look at it in a holistic manner. And that actually, interestingly, could be an area which could be tackled by technology in itself, be it, again, there is some transference even with doing that. However, overarchingly, I think one of the areas where we're seeing critically a lot of value created with technology platforms in terms of risk management, critically compliance and legal risks and operational risks, right? Innovation comes at multiple levels, and I think returns are to scale the higher up you go. So at the bottom you have process, then product innovation, business model innovation, and company level innovation. Financial services is still at a very low level of innovation in process and product, but the reason it's staying at such a low level is principally because there's so much opportunity there. Yeah. Right? It's fundamentally huge in terms of, I've sat on recently on a board of a private bank in Luxembourg, and it absolutely astonishes me how fraud can so easily take place due to so many manual procedures being put in place. You know, just using NLP, voice recognition technologies, AI, machine learning, and other technologies, you could minimize that, connect all the dots, and reduce a lot of the costs that are being incurred onto institutions. But I do sometimes think, I mean, generally I take the approach, I started my life in market risk, and I've always taken a risk-based approach to starting a business. Good ideas are two a penny. It's the way you cater for the worst case scenarios that ensures whether you win or lose, I personally think. And I do wonder often about how we can create this holistic picture of risks, how banks can better manage that across the board rather than looking at things in silo to ensure their greater stability and avoid some of the shocks that we're seeing. Employing AI is one way. I mean, a lot of what's going on in the US and across, which will have some contagion into Europe and the rest of the world, is related to the balance sheet and the valuations and market risk, right? Now, therein, there are better financial basic models of mathematics, Bayesian calculus, machine learning, be it unsupervised learning models, etc., that could create a better picture. But again, the banks are going to do minimal requirements based upon what regulators require of them rather than look at things holistically. So there's a variety of different areas to look at, but we do need to look at it together, I think, and that's, I think, the next phase of where we're going in terms of the technology adoption.
Rohit, I mean, in terms of what Nasser mentioned has a lot to do with leveraging data itself, right, and data analytics, and being able to going back to the basics, but again, the basics still need to be mastered despite the fact how advanced we have become. Biz2Credit, for you, as you mentioned, data points have been key. Data points have been playing a pivotal role in terms of understanding risk for you a lot better. How can you give us some more practical use cases that Biz2Credit has used when it comes to leveraging data analytics and then being able to understand risk better? One. Two, is from your understanding and your partnerships that you have been doing with other financial institutions and players, what is their level of understanding till now, I mean, on leveraging data analytics too?
No, I think good question, and just to expand on what he said, like, I think, as I said earlier, it's all common sense. So like in US, why banks are failing? Because while everybody was doing a stress test on asset quality, nobody did a stress test on the interest rate increase. Everybody forgot that, there's an asset liability mismatch. So as simple, thing like, okay, and once they realized it was too late because nobody had even done a stress test that Fed can increase the interest rates by 500 bips in a year. Now, coming back to your question, I think it's a very relevant, piece that how do you leverage data? So obviously, what we are seeing, COVID-19, what that has done is that, the data has become more digital. And the way it's happening is not because institutions want it or banks want it. It's more the consumer, the borrowers, the customers, the depositors want it. And that is starting to happen, which is, again, going back to banking crisis, why we are seeing bank deposits going out and why we are seeing runs on the banks happening so quickly in US, because now everybody can move their money into a money market account at a click of a button online, and you don't need to call your broker or call anybody else. So from a data aspect, I think that is becoming very important, that how you, now, as the access to data gets better, the risks are also increasing, actually. So I think one has to keep that in mind, that everything comes with pros and cons, and that's, we are seeing more and more. So a great example that we have seen is in transactional data. So what normally used to happen was that earlier when any businesses used to come to borrow money, they used to give us a data at the time when they are borrowing, and that's it, and then you're really tracking them based on the repayment track records. Now what starts happening is that once you have full connectivity into their bank accounts, we can map even outlier deposits, outlier, inflows and outflows. So let's say an average transaction value is $100, or let's say $1,000, and all of a sudden they are getting money, $100,000 going in, coming out, too many times. And that's actually very important for a market like UAE, which has flight risk and trading community, and trading, piece. That all of a sudden, if you start seeing outlier deposits or withdrawals, that's an area of concern, and that's a red flag, actually, a lot of time. Now, as if you're trying to do it in a supervised manner with human beings involved, you cannot do it. That's where you need unsupervised learning. You need algos. You need to run it against the rules engines, which should again be configurable, kind of stuff. Because we have seen that when that starts happening, that all of a sudden you see these massive outflows and inflows, massive compared to what they should be. That leads to either other challenges for the business. It could be AML challenges, or it could be even performance challenges.
But have the banks been investing into it? Have you seen the bank? Because globally they say 58% have been investing into this, into data analytics. But have you seen in the region this uptake?
Yeah, so I'm coming to that. So what we have is another part of our business, Biz2X, where we license our platform to a lot of banks, global banks as well as local banks. Banks historically have been very slow to adopt to these technologies. They're just starting to catch up. I think the big challenge for banks in US, and we are also launching a platform in this market in July. So now we are interacting with a lot of banks in the region. What we are finding in US is they're being forced to change because the whole business model for a lot of banks is under threat. Because typically banks used to take deposits, lend money, make the margin out of it. Now branch networks have become very expensive. Nobody is going to a branch anymore to deposit money. So one of the hottest products that banks now want is account gathering platforms, which can be fully digital. And I'm talking on business side. Because in a country like UAE today, if you are coming from outside of UAE and want to open up a business account, it takes 3 to 4 months today.
Yeah, still does.
Huge, I would say, it's part of it is inefficiency, part of it is absolutely, there's a KYC and KYB challenge. Part of it is, banks are so risk averse, they don't want to, they're like better, safe than sorry kind of a mindset. So banks historically have been behind the curve. US, we are starting to see a consolidation in the banking industry at a very rapid pace, which has been forced by macroeconomic conditions. That's forcing more and more banks to start thinking about using more of the technology, the data analytics, and risk factors. What we are finding in a country like India, where we also have a large presence, is that the government has really done a phenomenal job in creating digital infrastructure. So a great example is like, if you remember, 10, 12 years or 15 years back, we got the number portability on your cell phone. And that changed the whole industry.
Yeah.
Same thing in India, what happened that the government created something known as account aggregation, where if you are an account holder in any bank, all banks are forced to share data.
Okay.
And then you can switch or you can borrow from anywhere else also, which wasn't the case. In UAE, we are still seeing very early days. We haven't seen that kind of a movement. And obviously, UAE is getting corporate tax also, in June. That will release a lot of new data. So my hope is that the market will catch up, but the way it catches up always is, it is led by the consumers, never by the banks. Banks are always forced to change. They never want to
Consumer
change
demand
themselves.
is that.
Yeah,
Yeah.
exactly.
Well, important thing you mentioned was, contactless. Important thing you mentioned was the boom that COVID brought. Right?
Yeah.
So, I mean, 3 years down, but we still talk about the boom that it brought. And Shailesh, I mean, you have been, again, at the center of it all with GDR. In the region, we have around digital transactions stand at around 72% as per the recent report MENA FinTech Association did. And then as per the report, we also found out 40% of the transactions are contactless, right? And this was the growth, by the way, 40% that we saw. Now, as this basically boom came in, that means a lot of pressure would be there on players like yourself who are completely, I would say, very deeply integrated into the merchant ecosystem, especially in Saudi, right? And in Saudi in specific, there has been a larger uptake of contactless transactions. Now, the moment you go contactless, the more digital you go, again, there's more exposure and there's more risk, which means your point of sale solutions also need to adapt to it, right? That could be probably revamping your point of sale solutions or your tech stack that you're using. What were some of the steps that GDR took at that point? One. Now, your response is also going to, I believe, help those players who are looking to venture into that space, or some of the merchants who might be sitting over here, to understand what are the important factors that we need to consider even when we are working within a platform or point of sale solution that we will be using for our own business.
Okay, so let me cover this one by one, right? Number one is that you're right. Digital transactions are booming, increasing, and I think post-COVID we saw that whole explosion happening on the
Yeah.
digital and contactless transactions, where people were averse to touching money physically, and there was a direct shift onto from POS to online or
Yeah.
e-commerce transactions. Now, what happens when you split these two transactions into two is that one is the e-commerce side,
Yeah.
which is happening, on your web, and the second one is the contactless, which is through your phones. Now, when your transactions are happening on the phone, they're actually more secure because you, as a consumer, have already done all the checks. You yourself have loaded your card. There was an OTP that was generated, and therefore it is lying in a vault where your card numbers tend to be much more secure. And if you look at the whole anatomy of that transaction, it actually throws a token. And the token is what gets captured, and it is highly secure transaction. So what we did in our world was to make sure that our systems could support tokenization. Those transactions could be accepted. We took a pole position in Saudi and in every other market that we operate in to make sure that the GDR POS machines were enabled with contactless transactions, and they could support contactless transactions, not only for the merchants that we acquire for ourselves, but also for the transactions that were coming through our bank partnerships, right? The second part of it was the transactions that were coming through the e-commerce gates. Now, there are various tools, and on top of those various tools, there is truckload of information that comes from the analytical side of the business. Right? They say, the data doesn't tell the whole story, but the data tells a lot of story, right? When you analyze that data, you cut it, you slice it, you dice it by product, by industry, by segments. There are a lot of patterns that emerge. It is your ability to process those patterns that help you mitigate risks from each one of them. Let me say it in simple layman's term, is that when a website is selling groceries, we know what is the maximum average transaction sizes of that particular merchant going to be. When we something out of pattern coming in, which is huge in relation to what they are selling, we know these transactions could be fraudulent, and then you can take proactive action against it. Same applies for luxury retail, same applies for hotels, for restaurants, reservations, so on and so forth. Now, you must have the capability, and we in GD have invested a lot of time and effort in investing in those capabilities to understand those data patterns, right? And we have then inbuilt it into our system so that we can stop or de-risk our system to as much as possible. I am not saying that the fraud doesn't happen. It still happens. There are still those odd transactions that will slip in, but they have been brought down to a very, very tolerable level. Now comes the question about what are we doing on the technology side. Well, the best part about GDI is that we have our own in-house product team, we have our own in-house developers, we have our own in-house technology team. They are continuously reviewing the architecture of the system. They are looking at what are the changes that are happening in the market, what are the new tools that are emerging in the market. How do we onboard that tools to make sure that the system becomes even more robust than it was, and it keeps in track to what's happening in the market space. And that continuous upgrade that happens allows us to offer not only the best-in-class service and best-in-class risk services to our own merchants, but also to our bank partners. So the tech stack, the development never stops. It's an ongoing process, and we are investing very heavily onto our tech stacks. We are spending a lot of money on making sure that we have the right talent and the right tools, and we continue to improvise and modernize the stack as we go. Even now, as we speak, we have a big hub coming up in UAE.
Okay.
Our new hub we are inaugurating in another week's time in Barsha. And that is all going to be our back-end staff, web product team, tech team. We're going to be just looking into how do we make our product more robust.
So while you're making the product robust, you're also talking about customer experience, right?
Yes.
And brings me to Tajinder in the case when you're basically talking about enhancing customer experience. Now, if you look into this specific space itself, on the analytics and credit risk assessment, overall KYC, It's a $30 billion market, which is only going to be growing more and more as we speak, because as more digital is there, there's more risk that's being exposed to. Tajendra, in terms of like Finvasia, what have you been specific seen when it comes to enhancing customer experience? So we understood by Silesia in terms of having your in-house teams, they're focusing on that, they're building, a strong customer seamless experience. Now, I would love to know and understand some of the use cases that makes the front end and the overall experience from the merchant customer to the retail customer a lot more seamless. What have you seen?
Give you essentially when it comes to end customer experience and financial services, so some of the very important things are identifying the customer, whether the customer is who he says he is, making sure that those identifications are private and secure, and then making sure that all of that process is also compliant with the regulation. And then also, making the whole UI UX experience seamless for the end consumer. So I'll give you one example, a problem that we solved about 7-8 years ago. In India, we were launching our financial intermediation business called Shunya. And back in the days, India still is a large country, extremely, technologically advanced, but there was no way to do a digital KYC.
Yeah.
In a very simple terms, right? The way the KYCs were done is you basically send a booklet with, all the filled in your name, your father's name, send us back all of these documents to validate that you are who you are, because brokers were going more national at that respect. And the whole process was like a 15-day process, and at least 25% of the applications would get rejected because the client forgot something. We looked at it, we're like, what are the problems? The problem is we have to identify the customer, we have to validate that he is who he says he is, we have to be compliant with the regulation, we have to give him a good user experience, and I have these tens of, or maybe hundreds of people sitting over here doing KYC. It's not solving a purpose. We reached out to the income tax department, we reached out to the KRA department, we reached out to the exchanges, and we created a process. Okay, let's create a process where we can validate. So we created a process where we would fetch the information about a customer by providing his permanent account number to the income tax agencies, and from their servers fetching all the information and all the details, then validating those details with the KRA, which is the central repository of the data information, and then processing the whole information and the whole KYC in an automated fashion by using OCR and by using basic AI checks that we could do on it. The whole process from 15 days went to 5 minutes. Instead of having 100 people doing it, I would have just a dozen people doing it. And we had to go through and we had to teach the regulators, the exchanges, that guys, this is the most accurate and the most efficient way of doing it. And we are addressing AMLs, we are addressing KYC requirements and all the other requirements that come along with it. As a result, the KYC got reduced from 15 days to 5 minutes. All of those other employees at our organization who were doing book checks could get now upskilled and could do things better for better growth of their own careers within the organization as well. And for regulators, they would not know just 3 pieces of information about a person, but 5 pieces cross-checked from 3 different organizations. It sounds, at that time, nobody was doing it. Actually, today, if I look at any major broker in India, everyone is now following the same process. And it does feel like, using all of these technologies, it does solve a lot of problems, and we can, one of the use cases what I just described.
We all agree with the fact that, using these technologies will make life a lot more easier, make the customer experience a lot more seamless. And this is the way eventually every banking and financial institution has to move forward with. And apparently, as per the global numbers, 85% of the financial institutions see this as a competitive edge. Yet, you see this as a major obstacle, right? Still, the surveys say something else, but in reality, it's something else completely. It's a completely contrasting picture. Nasser, you have been again on the global stage, seeing and working with the banks as well in Europe and in the US as well. How do you basically see, and why do you see that these obstacles still exist for the financial sector itself, despite the fact we see numbers that, oh, hey, okay, we want to have this as a competitive edge, but you know what? We still don't want to do it. So what are these internal obstacles that you have been seeing?
I think it's actually very simple. The traditional financial institutions are being bombarded with regulation all over the world, and a lot of that regulation is requiring them to implement a new process, which in most cases involves new technologies or changes in legacy technologies. I mean, one of the biggest in today's world is managing ESG risk, right?
Yep.
In Europe, banks are having to comply, and it's a complete and utter mess. Where to find the data, how to process the data, how to aggregate the data, how to cleanse the data, benchmark the data. It's all going to require tech, right? What we need to remember is banking sector KPIs are the worst they have been in the history of banking, right? Ironically, sadly, Europe is the worst performing banking sector in the world, where return on tangible equity is well below 2%, return on assets, return on capital, and return on equity is worse than Japan. We took the crown from Japan 2 years ago, right? And to be fair, no sector is performing particularly well. Asia still outperforms in general, but those numbers for those key KPIs are well below what they were pre-financial crisis. There are some exogenous factors such as increased capital requirements, etc., but ultimately banks are not doing well. And then we're asking them to spend more money, right? They're firefighting on a daily basis. What I have seen as a trend in Europe particularly is the complete turnaround in looking at the banking business or financial business strategically to looking at it as we need to fight fires on a daily basis, right? Most of the new CEOs or regional group or country MDs that are being put into place by banks in Europe come from either an operations, financial, or risk background or compliance background, right? They're not visionaries anymore. They're being brought in to fight the problems that they're getting on a daily basis. So there are massive hurdles for institutions to implement these technologies. Obviously, this is boom time for the tech sector, right? Because a lot of what's being required of institutions is presenting massive opportunities to technology companies. But it's problematic, and there's going to be a bang at some point.
Just a quick question, I mean, and this is open for everyone, right? So, I mean, and it's linked to the last question, which is, what technologies do you see having the most potential in helping mitigate this risk? And I just wanted to come down to open finance as well, because we were just having a roundtable before on open finance. How do you see open finance and open banking companies as a critical enablers for this? This is open for everyone. And any other technology that you would like to mention?
I think the most promising as of today, because technology changes very fast and it's hard to say, but as of today, I see AI and blockchain as the leading technology that could help us transform financial services. And when you combine them together, it's just magic.
Yeah.
You have a lot of large data that you can crack down on, reduce the frauds, comply with the regulations, provide better streamlined services. Blockchain can create transparency, speed, reducing intermediaries from the whole ecosystem, and you put them all together and you have something that we have always been cribbing about, why banks are banks and fintechs are fintechs. Yeah. And that basically could make the transition for banks also start behaving like fintechs.
Fantastic. You have something to say?
Can I respond to that very quickly? I mean, again, look at the cost involved to the banking sector to implement blockchain or AI technologies. Even the data side of a bank is so poorly managed.
Yes.
A lot of banks are running, particularly in Europe and traditional finance sectors, are running on core banking systems from the 1980s, right?
And
how are you going to deal with that?
Essentially, it is the capitalist economy, and things that cannot survival of the fittest. If they can keep up, there's consolidation in the banks, and we see a lot of banks are not making money these days. Why? Because they cannot evolve as fast. I'll give you one of the examples, and because we are low on time, when we launched one of our products in India, Shunya, the goal was, how do we revolutionize financial intermediation? And we said, okay, a broker has to go to a clearinghouse, has to go to an exchange, and has to have a technology, and that is why it cannot innovate so fast, and they have thousands of employees. We bought the whole food chain, we made everything zero cost, and then I was not able to hire employees because they're like, you're not charging commission, how do we make money, how do we survive? And we had to train people, bring people, and skill them in a way to build that thing. But I think it's the survival of the fittest. If they cannot evolve, they'll perish.
Fantastic. Great comments, great closing comments. And I would like to thank you all for being here this year for Dubai FinTech Week, FinTech Summit. I'm still in Dubai FinTech Week, but I would say this is going larger and bigger and better. And look forward to seeing you all next year as well. Thank you for everyone who flew in from different parts of the world, and for the panelists as well for sharing the key insights and inputs. And feel free to reach out to them for any questions or queries pertaining to the subject. And thank you very much for your patience and being a great audience. Thank you.
So thank you. Big hand for Namir, Rohit, Nasir, Sailesh and Tajinder. So this is the panel where we learned that the inefficiency cake got taken by Europe from Japan, that you can improve your KYC from 15 days to 5 minutes. That's surely an indicator that you want to achieve. Need to use AI to mitigate risk, and in transaction monitoring, you've got to build your data analytics capability, and blockchain's got a place at a number of different levels in the future of monitoring risk in banking. So thank you very much to that.